You're all doing good. Is your host Aman, and welcome to my channel. So if you are new here, kindly subscribe, do well to like, and turn on notification for more content like this. So now, yeah, we've talked about how you can combine MSNR with CRT, right? In the first episode and the second episode. Yeah, so this is going to be the third episode on how you can actually combine MSNR with CRT, right? So now basically here we've talked about how you can use the A-shaped key level, which is this first case scenario, right? This first case scenario here. So here, I told you guys something that you can't really just consider trading random CRT, because that means you're actually trading patterns here, which is supposed not to be. So you are here to trade logic, you're here to use logic, and logic will actually help you a lot. Even though when the pattern is not presenting itself well, you have to use your logic well. So here, don't trade patterns, instead admire the logic. So now basically I said CRT works best with rejection from A-shaped key level, a V-shaped key level, or as the case may be, either in a buying trend or the selling trend. So as the case may be here, here we had this A-shaped key level here, and you see we have this CRT candle high and the CRT candle low here. The candle range theory, that's what we call CRT, right? We have the high of the candle and the low of the candle, right? So if you take out the high first, the nearest target is going to be the low of the candle. So which makes more sense that you are actually adjusted from an A-shaped key level. So this is the summary of what we discussed in our first video, right? So in the second video, this is the summary of what we discussed. So in a scenario that we're actually in a continuation trend, right? So this is going to be like a breaker block in a CRT manner. So this is going to be a breaker block in CRT manner, in the sense that there's a A-shaped key level here supposed to sponsor more sells to the downside, right? Eventually got broken to the upside impulsively, right? So the moment that A-shaped key level goes broken to the upside, then it becomes a resistance broken turn support, right? So for this, so the formation of the CRT here still makes more sense in alignment with the breaker block. So now today we will be discussing how you can actually combine fair value gap here with CRT formation here. So basically here, what we call fair value gap is all about inefficiency in price action, or how will I say it? Yeah, inefficiency, fair value gap, or what can we call it again? So here basically we have inefficiency, fair value gaps. Here I think there's another thing we used to call it, but here forgotten already. So now the fair value gap inefficiency is here already. So it's created by a series of 3 candles. So it's like a gap between 3 candles, like a gap. This is the first candle here. This is the first candle here. Come in, let me try to turn this off. So this is the first candle here, the second candle here, and the third candle here. So the gap between those wicks, between the wicks of those candle, of those 2 candles here, the high and the low of these two candles, is called the gap. It's called the fair value gap, right? So this gap from here to here is the fair value gap. So in this scenario, if you have a CRT here, here, taking the high out and mitigating this fair value gap here, let me try to do it this way. Taking this candle high out and mitigating this fair value gap. Let me try to make this white. Yeah, so yeah, this is the fair value gap I'm talking about. So yeah, let me make it like a green color. So here exactly. So now this is the fair value gap here. If you have a CRT taking the previous candle high and mitigating the fair value gap and closing below, then you know that okay, this third candle is going to sponsor the distribution leg to fulfill the CRT criteria, right? So now, to cut the long story short, let's move on to chart and let's explain this here in our chart. I believe you all can understand my analogy here. That's why I have to just move to the analogy first and foremost, so that you can actually just understand the whole concept better here, and also do well to leverage your knowledge that you see online, because they say there is no free knowledge anywhere, and mind you, you can even with the free knowledge you have to pay attention. So there's sacrifice for everything, so you have to pay something to get something in one way or the other. So here, let's do it this way. Let's move straight to our chart. So let me try to clear all this out here. So now me clearing this, let me try to delete all drawing. Yeah, I'm coming. Before I do that, I think I have to just take a screenshot of this. Yeah, exactly. So which makes more sense. So now basically here, let's proceed, right? Let's proceed. Okay, so let's proceed. I'm trying to clear all this. So clear all image. Yes, okay. Clear all drawings. So it makes sense, right? So now basically what we do here in chart is just for us to just build our directional bias from higher time frame. Then we look for lower time frame for the rejection and the confirmation. First and foremost, we build our time frame directional bias from higher time frame, rather directional bias from higher time frame, like that. So from the weekly, from 3 months to the month, from 1 month to weekly, from 1 weekly to daily, from 1 daily to H4, from H4 to H2, H1, 30 minutes, 15 minutes for entry, all those higher time frames are key. So now let's go on our daily time frame or our monthly time frame to see who we are dealing with, right? So now this is on our this is I'm using our USD for this particular analogy here. So this is USD where is this pair coming. So now basically here we have USD. So here this is USD. I'm looking for the pair. Where is it? Okay. This is USD. So yeah, basically you are using USD for this. So take a look at what we have here. So let me zoom out so that you can see clearly here. So basically I said we are building our directional bias from higher time frame. So this is actually a weekly time frame level here, and if you could pay attention, there's a CRT high and a CRT low here, but that is not low. I'm going to the imbalance part here. So now take a look at what we have here. Let's go as far as our monthly time frame to see a clear picture of it. So what am I saying today? So this makes more sense here. We have series of movement to the downside, which clearly shows that we're actually bearish. We're bearish in the whole overall trend, right? So now take a look at it here. So the overall trend is bearish. As you can see, we have a very major break of structure here. It's actually a week to body break of structure, not just a week to week. So it's a week to body break of structure. Even on line chart, you could see it very, very clearly. So take a look at that. So you have a very nice break of structure here on a line chart as well, and also in the body of the candlestick, which makes more sense. So we anticipate more sales to the downside because the last break of structure that we had is actually a body to week break of structure. So what do you have here? We are left with series of bearish candle creating an imbalance. Here you could see something very, very awesome here. Take a look at this. You have this high here, that's our imbalance, and we have this low. And this higher that are here from this high of this candle, the opening of this candle and the closure of that particular bearish candle. So this is actually our imbalance here, and also this is going to be like a CRT candle high for us. So which makes more sense. Like this is on a monthly scale, and we have this level as our target, right? So this is actually what I was drawing, or I was trying to explain earlier on before I proceed to this here. So now let's take a look at this. How can I join this movement? How can I trade this in lower time frames? How can I even join the whole move subconsciously or consciously? How do I do it? Is very easy. So take a look at this. This is on the monthly scale. We are adjusting from an higher time frame imbalance. So let's go to a weekly time frame to see what we are looking at. So you can actually just refine your whole thing here. This is actually the imbalance. This is actually the imbalance you are trying to mark out here, and this is the high, right? So take a look at it. So the fact that the imbalance is on higher time, is on a monthly time frame, and you check your 1 week and you don't even know where you're actually marking out again, this is what you do. This is how you approach it. You have to keep that imbalance in mind, and secondly, you have to work with whatever structure you have on that particular time frame you are in alignment where you are looking for on higher time frame. You see, the weekly imbalance is already fit already. So whatever you have here is not looking like an imbalance. Instead, you are seeing an A-shaped key level and a V-shaped key level. So just mark them out here respectively. So you have this A-shaped key level here, mark them out, and you have this V-shaped key level again, mark it out together. So which makes more sense, right? So here makes sense, right? Makes sense. So yeah, basically we use this so you just delete the imbalance level. Yeah, just delete the imbalance level, or you can just try to make the line 18-1, so you know that okay, these are my imbalance level, and this is where I'm indicating from one of these levels. And mind it, here we also have a disrespected V-shaped key level, which is supposed to be here. So this is actually disrespected V-shaped key level here, so which makes more sense, right? You can see it's very, very clear. You see, so we have 3 zones here, 3 zones of interest. Yeah, POI of interest. So yeah, we have this disrespected pull close a V-shaped key level rather. So here you have these levels here on the weekly scale. You are not looking for your entry, so you can actually just define this here to our weekly scale, because this is actually where we actually ejected our imbalance, right? So here you're not just here to look for what will I say, you're just not here to just look for entries directly on a weekly time frame level. Nobody takes entry on a weekly time frame. You're just here to be directional bias from weekly level, right? So this makes more sense, right? This thing makes more sense, this suggestion makes more sense. So now let's investigate that on a daily scale. So if you go back to your daily time frame and check, what do you see? What do you have here? What can I do with this? So this is actually that level, and mind you, this is still in alignment with our imbalance as well. So take a look at this. So this makes more sense, right? So this is like a daily rejecting daily, because the candle actually closed below it. So what do I mean? A daily rejecting that particular daily level. Are you following? So yeah, a daily rejecting the previous daily level here. You know, we mark that level out from a weekly level. So this is like a daily rejection daily, and mind you, this daily rejection also overlaps an imbalance. So where is the imbalance? Here. From here to here. So I'm trying to make a very well detailed top analysis for you guys. So here, so you have this imbalance here. Let me try to use this to draw it for you so that you can see. So you have that imbalance there. That's the imbalance that we have there. So which makes more sense, right? So that's the imbalance that we had here, right? So after the imbalance, so we are now reversing. We are here, we are looking at this. We have this level, like a daily rejecting daily kind of thought here. So that after that daily rejecting daily, what do we look out for? We look out for a breakout to confirm that movement. So we are looking for the reaction, the rejection, reaction, and we look for the confirmation as well. So here, this is H4. Let's look at H4 and see what's going on H4, right? So on H4, what do you have? On H4, what do you have? We have a very nice break of structure to the downside, a very nice one. So let me try to delete some drawn lines so as not to confuse you. So let me delete all this imbalance line as well. So you are dealing with this daily rejection here, so which makes more sense, right? So after that daily rejection, what do you have? You have a break of structure on the line chart. So what do you have? You have a breakout here. The first breakout that we had was here. So I used to tell people, I used to tell my students that okay, whenever you see a breakout here, the best fit for it is going to be like a 2 break of structure, because if you have 2 break of structure, you have already ascertained the fact that okay, we are now bearish. The chart has already changed the direction. We have a change of character already. So we break this low, and also we break all this minor low. If you check your line chart with markers, you could see very, very clearly that this actually break of structures, right? So it makes sense, right? So exactly. So let's go back to our chart and see. So I said something that okay, if you are framing entire bias, is your bias, your POI is a factor of how deep your inducement liquidity is, or your engine liquidity is. What do I mean? Liquidity are known for the first pullback. Inducement or engine liquidity are known for the first pullback after a break of structure, or as the case may be, or before the break of structure, right? So we have this after this major break that we had here. Come here, let me try to deep here. After this major break that we had here, right? Where is our pullback? So this is the first leg pullback that we had to the upside. This pullback here. This pullback that we had, then we had this. So that's our first pullback on H4 that you could see very, very clear. So but mind you here, you can also pay attention to this. So majorly, you know, we have to sell from a discount level here, like 50% level, 50% above level. Then in a buying scenario, I don't really know the premium on the discount kind of thing, but here the logic still remains the same. That okay, if you are buying something here, you have to buy it at I think the premium level is above and the discount level is below here, but still boils down to the logic. So if you have to buy something, you have to buy above. If you have to sell, if you have to sell something, rather, you have to sell above. You have to buy below, rather. So you have to buy from the deep and you have to sell from the top. That's just the basic logic behind it. So take a look at this here. So the moment you identify this range from this high to this high, from this high to this low here, so your reversal, the inducement liquidity leg, I said something earlier that your POI is a factor of how deep your inducement liquidity is, your inducement leg is, how deep it's moved. If you are going to use a breaker block model, you are going to use the ABC pattern, whatever you are using here, it's a factor of your liquidity. So mind you, your liquidity movement actually goes beyond the equilibrium level, which makes more sense, right, to sell from that particular level. So what do we have here? We have our liquidity high here. You have the liquidity here, which makes more sense, right? So take a look at what we have there. So please pay attention as I'm taking you step by step here. So we have this movement here. This is an engineer liquidity. This is an engineer liquidity because why? We did not break the low again here instantly. So it's an engineer liquidity. So the engineer liquidity is all about, as the name implies, engineer. So take a look at this. So where is the nearest POI that I have that is very close to my liquidity zones, which is here. So where is the nearest POI that I have? Is it the A-shaped key level? Is it the V-shaped key level? Is it the open close key level, as the case may be here? So now take a look at what we have here. I said if your A-shaped key level is very far from your POI and you have ABC pattern, you have a breaker block model very close to your POI or your liquidity, then you go for the breaker block. Yeah, if your KMR level is very close to your liquidity and very far from A-shaped key level, you go with your KMR level. So these are the things you need to pay attention to. So what do we have here? We have a we have a V-shaped key level here. These levels, these are the levels that we have that are very close to liquidities, and we have this one as well. We have this KMR level as well. That's the one. These are the ones that we have very close to liquidities, right? So which makes more sense, right? So here, so basically this is how you navigate through it here. So we have this level very close to liquidity. That's the V-shaped level here, and here exactly, which makes more sense. So what are we looking at to do now? First and foremost, this makes more sense, right? This makes sense perfectly. So here, just be with me and let's proceed. I'm coming. I'm trying to make things for you easy for you here. So take a look at what we have here. If you pay attention to this on a daily time frame, you see that particular level is an open close key level. So here, another thing you have to know is that when you have two zones that you don't know which one you have to pay off, you can just switch to your line chart or you switch to your higher time frame narrative just to see which of these time frame, which of these POI still holds on a higher time frame level. Please write all these things down because you need them one way or the other. So we are moving from one liquidity level to another, which is from here to here. You see, this makes more sense, right? See how we use this whole imbalance to build our directional bias from that time frame to this particular level. So take a look at this from this level, first and foremost, here to this level at first, right? The overall trend is the overall target is going to be this particular low. Let me show you. The overall sell is going to be this particular low. It's supposed to be like 14-hour trade, right? Yeah, just imagine something like that. Yeah, because you just know that you have to move from one liquidity level to another, because markets will not really come very straight like this to the downside and take profit out unless there is a high part news or something like that. So which makes more sense, right? So here, take a look at that. So take a look at that. So moment you actually ejected from that level, we have another strong high here. What is the stronger? Stronger takes out the previous high and at a break of structure, which is multiple break of structure in a very nice scenario. So we have this here. So we broke like 3 structures already, making that high a very strong one. This one here, so we broke multiple structures already. We broke this low, and we broke this low, right? So which makes that high a very strong one after this whole rejection from higher time frame level, right? So go back to your line chart and see. So where is our first pullback after a break of structure? This is our first pullback after a break of structure goes does, right? So these things are not really technical, they're not really that hard. Just have to open your eyes and pay attention to charts. Yeah, we have this first pullback after break of structure, which is supposed to be here. This pullback here, right? So after a break of structure, we have that pullback as a liquidity level, right? So here, basically, you mark the high out. Yeah, the high. So what POI is very close to my liquidity level? This is the question you ask yourself. What POI is very close to my liquidity level? So this makes more sense. Am I to use this KMR level, or am I to use this open close key level of the KMR level, right? Which of these is very close? So the open close key level of the KMR level is very much closer than the A-shaped key level. So you have to use the open close key level, right? And even though you are putting your SL above this particular high of the KMR level here, just to be very safe. Yeah, that's how you know how to put your stop loss. This makes more sense, right? From this level again, yeah, above here, then to the downside again. So this is also 8-hour trade, right? Are you with me? So this makes more sense. This makes more sense, right? This makes more sense. Take a look at it. So we have another break of structure here. We have this break, multiple break of structure to the downside. You could see them clearly on line charts. We have that break here on line chart as well. So after that break, what do you have? After that break, what do you have again? You have a pullback here. So this is actually the first pullback that we had. Here we have this first pullback. Then all of a sudden we have the second one here. So the low of this pullback is here. We have these movements like this to the upside from this, right? So this high is going to go for the pullback to hold. So this is going to be a liquidity level like that. So it makes more sense. And if you have to draw your range, is it falling beyond the equilibrium level? Yeah, it's falling beyond the equilibrium level. So you are drawing from here to here. Are you following? So now makes more sense. So just jot a lot of things down and backtest them back on your chart. So this is going to be your high. Where is this? Where are the liquidity? Where are the zones very close to my POI? So we have this open close level here. Exactly, and we have this gamma levels. So how will I see all these levels? You just go back to your line chart, you see them. So here, and I said something earlier on, the more the rejection of these levels, the stronger they are. So take a look at it. So even if you are going to take the KMR level, you have to place your L cell above the KMR high. This one, just to be very safe. Yeah, I believe you are learning one or two things from this video. Yeah, and if you find a video helpful, just do well to like and subscribe, and also do well to turn on your notification for more content like this. So take a look at this eye, then this makes more sense, right? This is almost like a how many hour trade is that? You have 7 hour again, so take a look at that. So that's a 7 hour trade as well. Exactly. So you have that movement again to the downside. Not until now we have a very major break of structure again to the downside. And yeah, after that break of structure, what do you have again? This is the first pullback that we had. Here. Then we use this imbalance again. You feel this imbalance, and this is the yeah, you have all these slows and something like this. All these gaps here. This is the major gap from here to here. So basically what we did here is just that we used the open close level for continuation to the downside. Basically that's what we did. But here, you know, they say it's not all trades are tradable. You just have to know your taste and what you're looking for in chart. Exactly. So this is our open close level that sponsor and sells to the downside. So just imagine if we could catch, this is actually the first one here, the 14 hour trade. This is the 8 hour, and this is 7 hour. That's okay for you, to be honest. To be very honest with you. So take a look at that. So let's still go back to how the logic still works. The logic goes thus: you take out the high, then you go for the low. That's just basically what we're looking at. Take out the high, go for the low. Take out the low, they go for the high. So I trust you've learned one or two things from this video today, and I trust you've wrote down some new things that you've learned as well. And I am looking out forward to you backtesting it on your charts. And also here it's nice to see you here again. I'm looking forward to see you in the next video as well. So thanks for staying to the end of the video. Do well to like and subscribe, and also share the link to your friends and family to see to benefit from it as well. So do well to have a very nice day, and take care. Bye everyone.